Markets are finally starting to see a little bit of follow through in the upward direction after today's gap and go, but I don't want to speak too soon, and I certainly don't want to jinx any follow through moves from the market right now considering the environment out there. So let's take an objective look at the data points and make an assessment here. I will say right off the bat that the market breadth has been improving throughout the duration of the week, which does strike me as a bullish data point, and we'll of course dive into that in this week's episode of the Midweek Market Update. Of course, if you have not done so already, hit the thumbs up button and subscribe to the channel. Check out the links listed down below and stay tuned until the very end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's kick things off here on the SPY daily time frame chart. What's going on from a trend perspective? We've got highs, we've got lower highs, we've still got lower highs and lower highs in this general zone from here to here. But I would be lying if I said that the daily downtrend is not weakening, right? On today's session, we have technically produced an equal high around 401. We have not yet produced a higher high, therefore we cannot say that the trend is neutral, but it's certainly a threat into the remainder of the week. If we find a higher high, it's then all about the higher low pullback to start to look for and confirm a new daily uptrend. So that is a big bullish threat into the remainder of the week if we see some follow through over the 401 level. We'll talk about structure in just a moment, but what else strikes me as more bullish than bearish? We have closed above our daily 50 SMA and our daily 200 SMA. Now, don't get me wrong, in previous videos, I have said that they've lost their importance as we've just chopped back and forth through them. That does hold true, but just objectively speaking, when you're above the 200, when you're above the 50, it is more bullish than bearish. What else is going on here? If we take out the Fibonacci's, we're going to start measuring the move from the high down to the low here because we want to determine when this downdraft is ultimately over. We're no longer as concerned with how deep of a pullback are we getting from this overall up move. And granted, the difference here, the delta between the two is very, very small. But regardless, where are we from a fib perspective? We're still in no man's land. But what I want to point out is that the 38.2 did hold as support on the Tuesday session. We did not fall back down underneath it, which, as we know, would have kept the bears more content underneath that area. The bulls are certainly more happy here for upside outcomes and the 100% retracement as an if we can get above the 61.8, which is coinciding with the upper edge of the weekly expected move and the structural resistance around 404.50. Let's take that off and see what's going on from an anchored VWAP perspective. If we come in with all of the anchored VWAPs from the October low, then using all of the other important pivots here, here, and here, we have made substantial progress specifically on today's session, gapping out of the VWAP band and now spending some time above the VWAP band. That objectively does strike me as being more bullish than bearish as well. We will start to anchor a VWAP down here when and if we can produce some equal highs on like a weekly time frame chart, much closer to 415. What else is going on? Well, from a pattern perspective, I would also want you to be aware that there is the potential now for an inverted head and shoulders to sort of signify the trend reversal here on the daily time frame chart. It would require a break of this resistance trend line here, a break of the neckline, therefore producing a higher high, correct? Then it's looking for the higher low. We confirm a new daily uptrend. So the threat right now is really that the bears get squeezed out of this market and we form a new daily uptrend. Now, there's objectively a lot of levels taking place on this chart right here. I think it's very clear, though, if we look at an hourly time frame chart, where everything is coming from. In the Sunday weekly watch list update, we talked about the tale of two ranges, right? Here's the upper range and here's the lower range. And this week was all about determining where were we going to spend more time, upper range number 1 or lower range number 2. I think we've got our answer so far. All of the time has been spent above in upper range number 1. Now, you can combine those two ranges and say something like this: we're just trading at the top of an overall balance. Well, if that's the case, knowing that we have an hourly uptrend in place with something that does this and something that does this, a break of this balance range should, in theory, technically double the range, correct? And that would, of course, imply a break of your daily inverted head and shoulders neckline. If this is the inverted head and shoulders neckline, if this is the range that is potentially going to break and we're going to see a doubling of that range, lo and behold, that brings us right back up towards these equal highs around 415. This is not a forecast that we're going here into the end of the week. I'm just speaking about structure and how this does strike me as being overall more bullish than bearish in the grand scheme of things. Let's talk about psychology from a gap perspective. We did gap up on the Monday session here, and we did fade to close that gap all the way, but notice what took place on the Monday session. There's a strong gap fill reversal. Now, if big sellers are entering the market, if sellers with a 3, 6, 9 month time horizon are entering the market because we're coming back and we're producing or trying to produce a lower high underneath the FOMC spike, it's a good opportunity to short the market, so to speak, at these higher prices. those types of sellers do not stop at the prior day's high, at the gap fill, right? So the fact that these sellers did stop there does not strike me as true selling strength. Now, granted, on the Tuesday session, yes, we did spend time underneath the Monday session range, but on today's session, right, what do we have? A gap and go, a partial gap fill, once again, sellers not really showing their hand as being strong, and a solid rally into the close. This isn't to say that the market needs to continue in the upward direction. We're trying to evaluate what types of participants are entering the market here. This, to me, is evidence that big new money sellers are not getting active. And this, to me, is evidence that big new money sellers are also not getting active. We can see the same thing in the internals as we evaluate Tuesday's down move as well. We'll do that in just a second, but here's the roadmap for the rest of the week. Obviously, the bulls are looking for an equal high break from the daily perspective, which is just a move up and over 401, and we built the case for strong resistance here at 404.50, Fibonacci 61.8, as well as the upper edge of the weekly expected move. That's if we just get straight up continuation in the upward direction. The other thing that the bulls can afford at this point in time, because we have produced an equal high, we can afford a higher low pullback to the bottom of the trend channel if we do something like this. That closes the gap, and if we find a higher low above 396.50, I would say that the bulls are still very much so in control of this market. Obviously, that leaves the bear case as being bears in control if we find a break and lower high underneath 396.50. It doesn't mean that we can't participate in downside moves during the remainder of this week. I would say that closing this gap could potentially be a short trade on Thursday or Friday. It's something to watch out for underneath 398.75. The gap closes at 396.50. I just wouldn't overstay my welcome on the short side when and if we're trading around 396.50. So that's really the roadmap that I can see going forward. Let's take a look at some supporting evidence. Market internals are Exhibit A. If you're not familiar with this screen, top right-hand corner's got you covered with a brief tutorial. From a volume perspective, we'll note that we've seen significant inflows on today's session and Monday's session. Tuesday was positive, even as we saw this drawdown, which doesn't strike me as, once again, big new money sellers getting overly active in this market. The cumulative read on the week thus far is hanging out around 766 million, which is above the significant read. We just basically use 500 million and negative 500 million as benchmarks to say significant or not significant. So inflows definitely powerful at this point in time. And I'm still getting questions about this study. It is available now on the site. You can check out the link down below. With that said, advanced decliner up in trend zone on the Monday session. On Tuesday session, even as we saw a red-bodied bar, we found support at the zero line into the close, which does strike me as being more bullish than bearish. Once again, new money sellers not really getting active here. And on today's session, of course, hanging out in the trend zone as well. The cumulative ticks down below speak for themselves. Nice and positive on the Monday and Wednesday session. And once again, new money sellers not really on the very, very benign read that goes negative on the Tuesday session. The flip side of this coin also is that in the past we had talked about the buyers not being new money buyers, and we were really just considering things short squeeze in the upward direction. Well, these volume flows paired with this advanced decline line and cumulative builds that are sustained builds throughout the course of the day, it does strike me that new money buyers are entering this market on the upswing, and this is no longer just sort of isolated as short squeeze pressure in the upward direction. So overall, this does strike me as a more bullish than bearish data point. Market profile is always Exhibit B, video tutorial in the top right-hand corner if you're not familiar with this screen. The main takeaway from the market profile here is really looking back to the FOMC day from back here. Remember that the value area was this zone right here. On today's session, the value area is now back inside of the FOMC value area. And I would also point out, very nuanced here, that the point of control is actually higher than the FOMC point of control. So steps in the upward direction are being met with good volume going through up at these highs, which once again strikes me as an indication that this is not just short squeeze. There are new money buyers committing volume at these higher prices. One deficiency in the market profile right now is the fact that we have a poor low from today's session. And as we know, there's also a gap underneath us. We had a partial gap fill today. So if we test today's low, Wednesday's low in Thursday or Friday's session, I would carry forward that this is a poor low and it should be repaired, aka we should move through it. It would technically trigger a short short trade to close the gap. And as we discussed on the SPY hourly chart, we are looking for a gap fill reversal off of that area. In the ES futures, it's roughly 40.10. The low of today's session, roughly 40.32, give or take. Jumping back on over to Thinkorswim to evaluate the weekly performance of our sectors thus far, we'll notice that the energy sector is leading the pack here, up 4.05%, followed by industrials, materials, and even utilities up here towards the top of our list. Note that all of these sectors are fairly lightweight and even D for defensive in some cases, specifically utilities and energy. Not really the greatest look to see that at the top of the list here from a posturing perspective, especially when we pair it with the fact that at the bottom of the barrel is the XLV for healthcare, the XLC for communications, and the XLK for the tech sector. All of those are heavier weight risk-on type sectors, barring the XLV, which of course is not great. Again, from a posturing perspective, not ideally what you want to see. But what I'll concede is that from a structural perspective, not just outright performance from a percentage standpoint, but structurally, we're getting some consolidation specifically in the XLK, in the XLC, and in the XLY. And if these consolidation zones can break out, then it's not the end of the world to see this bearish posturing, this defensive posturing, I should say, with the lightweight sectors at the top of the list. So speaking of structure, let's just dive through the charts and make some comments about what should take place if the market's going to remain bullish. So here's the XLE energy sector. We know it's lightweight. We know it's defensive. It's coming in for a back test of the overhead range and overhead supply lows at 82.65. Not the end of the world if this rejects here. I would ideally like to see it find a higher low and stay above 78.50. As and if this pullback takes place, we are looking for then outperformance in the XLK, XLY, XLC, or even the XLV. We'll talk about the XLF as an outlier case in just a moment. Obviously, banking crisis comes to the forefront there. So energy, not the end of the world. If it does continue higher, upward pressure is still upward pressure for the S&P. If it does pull back, we're looking for the rotation back into the heavier weight risk-on type sectors. Similar things can be said about industrials here. If we take a look at this chart, we're certainly back inside of the overhead balance after a look below and fail and another look below and fail. We talked about this in the weekly watch list update from Sunday. We're above the neckline of a potentially double bottom pattern. So as long as we're above 98.70, strikes me as bullish pressure for the S&P. Recall that in the lightweight sectors, it's really about making a new pivot high or a new pivot low. So really more neutral in here. Don't get me wrong, slight bullish pressure, but it's much more meaningful if we can get above 103 or if the market falls back down underneath 95. Next up, XLB for materials. I can't remember if I just mixed up industrials and materials when I was saying the name there, but regardless, this is materials, XLB. Same idea, right? I'm not going to rehash the same sort of psychology, but double bottom neckline. Ideally, it stays above 77, continues above 79, bullish pressure in this general zone because it's such a lightweight sector. You know the deal, neutral. Next up, XLU, D for defensive. Similar comments as to what we just said about the energy sector. Ideally, this finds a pullback here as the rotation takes place into tech, into discretionary, into communications, and then we see a move like this as this comes to a completion, right? It's all about this rotation. Usually the risk on sectors want to move higher, then we see consolidation, and as that's taking place, we see the risk off sectors move higher to catch up, then the risk off starts doing this, heavyweight does this, then we see this, right? So it's who's leading who. Ultimately, right now, the risk-on sectors are still leading the market. These are just playing catch-up. And we'll see that, structurally in just a second as we get to things like the XLY. But for now, XLF, what's going on in financials, this is where we need to start paying very, very close attention into the end of the week. Right now, we have experienced a look below and fail. We have spent some time above 31 all 3 days of the trading week, but it's all about getting back up to the equal high at 32.25. And you can probably imagine why. If we fail to get all the way up here, then what has the market technically done? If we roll over back towards 31, we've produced a lower high. And coming back down into this equal low breakdown area, that would certainly be a cause for concern, noting that the downtrend is really substantial off of the lower high, and we're looking for follow through in the downward direction. Being a heavier weight risk on type sector, that does not bode well for a stronger bottom forming in the S&P. So very, very important that we make it to 32.25 in the XLF in the near term future, be it Thursday, Friday, or even early in the upcoming or next week's worth of trade, I should say. Next up, here's real estate, really lightweight sector, has much more to do with the wealth effect, getting back into the neutral box, more meaningful as and if it breaches over 39.75, not really in play into the remainder of the week. This does strike me as a neutral data point for the market. Next up, XLY. This is where we are starting to see some of that consolidation, that congestion, right? So we have technically held up for a daily higher low above 141.75, but the objective once again is for the equal high or the retest, so so to speak, of 148, which we know really represents the top of this range right here. It's pretty paramount that we produce that higher high above what was happening here from the FOMC breakdown and confirm a new daily uptrend with lows, higher lows, highs, and a new higher high. So really watching for 148 on the XLY consumer discretionary as a more risk-on type indication. If we just continue to go sideways here, it does start to become a concern, noting that you're still dealing with this as an overall down move, right? If we don't make that equal or higher high here, not really looking all that convincing, right? So really watching the XLY structurally, how it resolves this little congestion that it's been putting in. Next up, XLP, risk off type sector. It is breaking in the upward direction, but recall, it's been barcoding for quite some time. It is not above 74 yet. If it is above 74, it is technically D for defensive, but as we've been talking about in today's episode so far, it's all about the rotation. Do the heavier weight risk on sectors start to pick up, as in if these defensive breaks continue in the upward direction? Next up, XLK, tech sector, the heaviest weighted sector of them all, the most risk on sector of them all. This chart honestly looks fantastic. Why do I say that? We'll talk about this in the QQQ as well in just a moment, but for the most part, equal highs in place. We're well above these highs from in the past. We swept the lows. This is the most important part from Tuesday. We swept the lows of the inside bars here, did not find new aggressive sellers even underneath the container bar low, and now we've rallied right back to the top of the range. So you could think of it as a micro look below and fail. We've hit the target. We're at the top of the range, but overall, this is now just forming a daily bull flag. Continuation up and over 147.85 brings you to your next target at 151.50. Once again, this is consolidating as we've been seeing outperformance in some of the lighter weight risk off type sectors. If this break continues, then fine. We have decent rotation. The market remains bullish. If this breaks down and then we see a pullback from the lightweight risk off sectors, that's a cause for concern. So sector dynamics really, really important to monitor here into the remainder of this week. It's why we're spending probably a decent chunk of time on it in today's video. I don't know exactly how long this clip is, but regardless, XLV is up next, going sideways here. Second heaviest weighted sector by market cap. Very important that this starts to put in the inverted head and shoulders, right? We already kind of established the right shoulder here. We want to remain above or around this 127 area. As long as we can stay above it, it's neutral or slightly bullish pressure for the market. If the market is concerned about recessionary type themes, you should, in theory, start to see this outperform up and over 129.50. We'll be keeping an eye on that level specifically as we move forward in the healthcare sector. Next up, last but not least, XLC Communications, very similar to the XLK, just in reference to this as an overall balance area, trying to form a daily bull flag. If it breaks, that of course is bullish pressure, and it's been consolidating as those lighter weight risk off sectors have been outperforming. So it's all about that rotation. XLC is another place where it's just very, very obvious that as this goes sideways, we're seeing some catch up, and now we want to see that rotation back in to risk on assets if the market is going to remain strong here for a healthy bottom. So sector dynamics, really, really great example, really great learning opportunity here into the coming week and even months worth of trade. Here's the sector ratio grid. If you're not familiar with this screen, top right-hand corner's got you covered with a brief tutorial on how to set it up. Overall, the top 4 sectors are the risk-on heavyweight sectors. XLK continues to be the glue that holds this market together from a risk-on posturing perspective. XLV does not look great as it is attempting a breakdown of these equal lows in here. That is a red flag and a cause for concern. XLF, we know the deal about the structural chart there. Obviously, there's going to be a dramatic amount of weakness here considering the banking crisis. And the XLY, it is starting to fade from its strength. Once again, the glue holding risk on together is the XLK. I wouldn't even go so far right now as to say that a full-blown risk on look is out there in the market. It's slightly risk on just because of this XLK, but really we're struggling in most other aspects of risk on. The communication sector is most closely tied to tech here, and you can see that it is outperforming over an upward sloping 50 SMA. So that does strike me from a posturing perspective, at least, as being more risk on than risk off as well. The bottom 4 risk off sectors, how are they doing, right? Are they perking up? Are they significantly outperforming? Not really. I mean, the XLP is going sideways here. The XLU is technically battling with a downward sloping 50 SMA. And in here in the energy sector, underneath a downward sloping 50 SMA, real estate, which is technically, again, deals with the wealth effect, but it can also be described as a defensive asset class, right? Hard assets, defensive assets, assets, it's not relatively outperforming. So risk off is not the total full-blown look, but it's only being held together a small risk on edge by the tech sector here. If we take a look at the XLY over the XLP for what we would consider growth versus value, it's going sideways as well. It's not aggressively, falling off of a cliff. Look at the acceleration here. Look at the acceleration here. We still don't have that as a look, and we're trying to make a stand at this area of support, which was once support, resistance for this final leg lower. As long as it can hold up above roughly 1.9, above that gray bar that we've sketched in here, I think that we're okay from a slightly more aggressive risk on posture. But if it starts to give it up, we will change our tone in this market. How's our good friend the dollar doing? It is consolidating underneath 103.50, which does strike me as bearish consolidation, no longer really threatening an inverted head and shoulders with an ideal right shoulder above that 103. It still technically could be in play, but right now I think the priority is looking at this from a weekly perspective. We've got lower highs, kind of lower highs in here as well, forming an H pattern. If we flush the lows, then of course that should be bullish pressure for equities down below. The relationship has roughly been restored. Obviously the banking crisis posed a little bit of an issue there, but as we've been getting this bearish consolidation, the market has been holding up in bull territory here. And the gold contract is also sort of confirming this. Having a look at the GC, you'll notice that we have beautiful bull flag consolidation up here at the highs. The pattern and everything about this chart would strike me as being more bullish than bearish, which again, based on the relationship between all three, would technically imply bullish risk on moves in the equities market with a lower implied dollar. Again, being flexible and open to this relationship changing as more information about the banking crisis, about regulation comes out. Inflation numbers obviously on Friday will be important here in this relationship as well. Let's take a look at the TNX and see what's going on here. The TNX is showing us a move back above the breakdown level. Recall that we did initially last Friday see a move underneath. It rallied to retest 34.30 here in the TNX, which is 3.4 in the 10-year, right? So it rallied for a retest. I was sort of looking for a rejection there, if I'm going to be quite honest with you. And obviously we've poked back into this little range right here. I think if volatility can remain contained in rates, aka we don't see a blasting move to the upside or an outright waterfall to the downside, I think it means more respectable moves out of our markets. What I'd like to see here is really just, noodling back and forth in this range here. If it does start to break, not a rocket ship to the upside, just a slow move back to the top of the range. What I will say from a technical perspective is obviously look below and fail. We want to watch and see what the reaction is at the top of the range. On today's session, we did find an inverted hammer. If we find a lower high and reattempt the bottom, once again, we don't want a waterfall. That really breaks things in the markets. But if we do start to move lower, that in theory should be bullish pressure for the market, considering that it lessens the pressure, rates that is, lessens the pressure on the tech space in particular. If we do rally over the top, it's not the end of the world from a trend perspective. We will have highs and potentially lower highs anywhere underneath 3.88 in the 10-year. Let's take a look at the Fed tracker tool. The market is currently pricing in higher odds of a pause in the next meeting, which by the way is May 3rd. There is no April meeting, but I think that there's an opportunity for this probability to flip-flop when and if the PCE comes in hot on the Friday session. If we take a look at the economic calendar, at 8:30 on Friday, we'll be live at 8:15 on the channel to catch the market reaction. We're expecting PCE to come in at 0.4. And if you recall, in the last PCE release, we were also expecting a 0.4. There was a huge upset, a big miss, and we got a 0.6. If that happens again, it's a huge signal to the Fed that, hey, forget about the pause. You need to go ahead and raise rates by another 25 basis points to continue the fight against inflation. Recall that we need to keep the two issues separate. Banking crisis on the left, inflation on the right. Keep them separate, tackle inflation, deal with the banking crisis. Another thing I want to bring up is that in the back half of 2023, in the past, we were sort of seeing how, hey, look at this, there was a bunch of cuts priced in. Notice that there's more time to pause here and not so much a concern about cut, which is actually a bullish implication. It's a sign that the market's seeing, hey, we're probably going to stay at these higher rates for a little while longer than we may have anticipated, but nothing's going to break immediately. When things start to break, if they start to break by remaining elevated, that's when we'll start to price in some cuts. And if we take a look at something called the Financial Conditions Index, which is actually over here, notice that financial conditions are continuing to get tighter, which is actually going to be helpful from an inflation read perspective. As this gets to the zero line or above the zero line, it represents tighter than average financial conditions. And this this probably runs contrary to what folks believe based on the quote-unquote, I say that very specifically, liquidity injection from the Fed taking on these assets from banks that needed a bailout, essentially, right? So as that bailout and the quote-unquote liquidity injection has taken place, financial conditions have not loosened. Even if we go to something like a weekly time frame chart, you can see that conditions are actually getting tighter here, even as, if we take a look at this chart, the balance sheet of the Fed has dramatically exploded, right? This is because there's a big difference between QE, quantitative easing, and the discount borrowing window being utilized. So, combine all of this stuff, and I think that the Fed's path forward, if inflation comes in at the expectation or above, no ifs, ands, or buts about it, it's got to be a 25 basis point rate hike. Keep the two issues separate. If it comes in at the expectation or below, maybe it stays in the Fed tracker tool, at least more of a 50-50 odds going forward. We'll continue to monitor developments, but as of right now, that's how I'm seeing it. The TLT is losing some relative strength to the equities market down below, which is telling us that the classic flight to safety trade is no longer in the forefront of the market's mind, speaking to a higher risk on type environment for equities down below. And the Fed tracker tool would sort of agree with this, or the TLT would agree with the Fed tracker tool, however you want to look at it, by basically agreeing with the idea that there will be a pause first before aggressively cutting rates, which in theory would send the TLT and bonds higher over time. If we take a look at the HYG, what's going on with junk bonds and the quote-unquote smart money continues to remain sideways in this range, threatening a move to the top and potentially breaking the top. That, of course, would be bullish for equities down below here and confirm more of an up move. Because this has not broken down, there is no major divergence. So far, so good. We'll keep an eye on it. Everything's kind of status quo as of right now. We'll, of course, update you if something needs to be updated. Let's take a look at the Bitcoin chart. And all I want to point out here is the continued risk on type nature of the move. Big bullish breakout. Beautiful high and tight consolidation speaks to a risk on environment, as we've said in the past. Less correlation with the S&P, much higher correlation with the NASDAQ 100. Overall speaks to bullish environments, bullish risk-taking environments as a whole. New highs versus lows is our first big improvement in breadth indications. Notice that we're sitting right back at the zero line after a big recovery off of these negative readings that were starting to threaten more of a look like 2022. Now, we're not out of the woods yet. We certainly have not produced new highs over this area from in here, but it is a step in the right direction. This does strike me as being a strong recovery data point instead of a big bearish data point. If we take a look at stocks trading above their 200 SMA in the S&P 500, recall that we were concerned about, and we still are concerned about, a rollover underneath the 50% mark. Ideally, this pokes back above and starts to find acceptance above the 50% mark. So far, this isn't the greatest look, but at the 50% is certainly better than hanging out down here on the lows. And we can say very similar things about stocks trading above their 50 SMA in the S&P 500. Even as this rally and the gap and go on today's session has taken place, we really haven't seen dramatic improvement from this reading. This does strike me as a cause for concern. One of the other big improvements, so the SPX A50 and A200Rs, really not that great, but another big improvement in my estimation is the equal weight RSP here. You'll notice that we're back above the December lows. Remember that this was a big divergence taking place. It was a threat saying that only a select few companies were keeping the S&P afloat. Now this is starting to threaten a break of the top of this range. If we can start trading back in here, that would be much more comfortable for the S&P from a breadth perspective. Last but certainly not least, let's take a look at the DJI and DJT Dow divergence between industrials and transports. What I would point out from this perspective is that if this can break out, if the industrials can break out of this and get more firmly towards the top of the range, that would start to bring it into alignment with the transports, which, as we know, have been relatively stronger than the industrials overhead. So watching very closely to see if we can get more firm price acceptance above roughly 32.5K in industrials. Volatility in the VIX specifically is also starting to indicate more comfort for our markets, getting back down underneath this key area at 2050. What was once prior resistance early on in 2023 was threatening support in the past week's worth of trade, and now we're back down underneath, which again speaks to comfort from the market, saying that this is starting to look okay as a local low in the S&P. If we take a look one step further behind the curtain at the VVIX, volatility of the volatility index, this would agree with the comfort that's being found here as we move back down into this range and towards 75. And taking it one step further, then even looking behind the curtain important is the volatility futures and the 9 versus 30-day VIX. So we know that traditionally this up here is really concerned with 30-day dated options and beyond. The 9 versus 30-day VIX, 9 versus monthly VIX, right, tracks shorter dated options, and you'll notice that obviously this is firmly in a contango underneath the zero line, but the shorter dated options are also now in a contango. Recall that as this is underneath zero, speaks to decent risk in the market. There is more risk in the future, so money managers are content with deploying capital today. It's not the inverse. This speaks to bullish comfort again in our equities market. Let's round out the broad market with the QQQ. We have gotten some recent feedback about folks wanting us to spend more time on the QQQ. Let us know in the comments section if that is a shared opinion or just an isolated event, and we'll try it on today's episode. So taking a more nuanced approach here, what can we say about the price action? Well, number one, today's gap and hold did ultimately hold and go. We did not produce an equal high to what was going on from the FOMC rally, but we also did not in the S&Ps. But I would say that because we're relatively equal to this high in the past, obviously the chart is way more bullish than bearish here. Also noting, just like the XLK, we saw an undercut of these lows, which were inside bar lows. There was no follow through from the sellers even as we breached the container bar low. We closed back in the range, and that of course sends prices higher. So I'm not seeing any evidence of new money sellers entering the QQQ. Even as we sit at relatively equal pivot highs, there was an opportunity for this to turn into something like a weekly double top. It simply has not. As of right now, what do the bulls want to see? Obviously just pure continuation into the upper edge of the weekly expected move and next structural target at 320.50, or bulls can also afford a pullback to close the gap and reverse off of that gap. I would say as long as we remain above 307.50, buyers are in control. We can take it one step further and start to do some additional analysis here as well. If we take out our Fibonacci's, notice that the 38.2 is suggesting as well that high and tight consolidation, bull flag consolidation really remains in place as long as we're above the double bottom neckline from back here, which is much closer to 302.75. If we throw on our anchored VWAPs, we can do the same thing in terms of coming in from the October low back here, pivot high, high, and pivot low down here. We're above this entire fan of anchored VWAPs, which once again strikes me as a bullish suggestion. It's been that way for quite some time. We know that there's been relative strength in the NASDAQ, and this of course is where that prior target is coming from at 320.50. So hopefully that was slightly more insightful than just saying something like, oh, the psychology is the same as the S&P. Let me know if you enjoy something like that for the QQQ and we can do it again next time, or we'll just revert back to our old ways. The IWM Russell 2000 is last but not least for the broad market, staying in bear flag consolidation. I just basically want to echo all of the same sentiments as we just discussed in the XLF financial sector, noting that we need the equal high up here. Otherwise, we just threaten lower highs in place if we come back down to 171. It's a different story this time around off of a significant lower high like this. Obviously, that is much more bearish pressure for markets. And as a general risk on, risk off indicator, that of course would not speak well for the S&P or even the QQQ. Big difference here. We are underneath all of the pivot anchored VWAPs. And if we take out our Fibonacci's, let's come in from the top of the breakdown to the low of the entire move. We're still underneath the 38.2. So bears are technically happy down here for bear flag consolidation. It's very apparent that IWM small caps, the financial banks, are really the risk to this marketplace at this point in time. If this does start to break out, the target's really the VWAP cluster and the big weekly level here at 181.10. Recall as well that if that break does take place, I do imagine we see a significant short squeeze there. And if the IWM is ripping here, obviously intraday, that will provide bullish pressure. The contrary for the S&P and the QQQ. So just something to be mindful of. The level to really watch is 176.75. Apple is up first for the core list of companies. Just like the QQQ, it has the sweep of the lows, close back inside, and of course follow through on today's session. And you could also just say that this is even stronger than the Qs because of course it is happening at a new higher high. So this is bull flag consolidation. A break here up and over 162.75 brings you to your next target at 167. Apple is looking fantastic, specifically based on the gap and go after this hammer candle sweeping the lows in there. So really bullish on Apple based on this structure. If it wants to continue to consolidate, that's fine. The longer the consolidation, we know usually the larger the break. Let's continue along here and take a look at Netflix. Apple, by the way, let's be responsible. Apple, by the way, if it does move in the downward direction, I would not be interested in shorts until we have a lower high underneath 156. It's got to be a failure back into this consolidation range down here before I'm flipping bearish on Apple. Okay. with that responsible take out of the way, let's move along to Netflix. Bull flag forming up here. I've got to give credit where credit is due. I thought a deeper pullback was going to unfold off of these inverted hammers. Simply not the case. If it wants to break out up and over 332.50, it's also breaking the daily 50 SMA. Next target overhead is 343.25. The inverted hammer lows are still technically in play to offer a pullback, but as of today's close, it doesn't look like they'll immediately be in play on tomorrow's open. Next up, we've got Tesla. What's going on with Tessie? Really love this setup here. Been monitoring it intraday, just never really getting the big follow-through move yet, but so far, look below and fail. Price acceptance back inside of this overhead range right here. Two ways to play it. Number one, look for the break of the hammer high tomorrow to get into 200, or the more patient trader is looking for the breach of 200 to break out of this range, double the range, brings us to the top of the overall range at 213. So a number of ways to trade that in the upward direction. Just like Apple, it would really require structure breaking down and a significant lower high underneath 188.50 for stronger shorts in the downward direction. Next up, we've got GOOGL holding that $100 pullback level to the T, and we've got an intraday pressure cooker top at 102.50. Here's the hourly time frame chart. Sorry, not pressure cooker top, rather just recapture of a breakdown bar high and breakdown bar high, right? If we can get back over this area, you can see that it's game on to the top, or excuse me, bottom of this prior balance. All over the place with my words on Google. So let's just continue along to Zuckerberg's fantasy land where the setup is much clearer, right? Obviously, a big breakout top at 207, clearing those highs. 221 comes into range as a target, chopping around in here. Not really interested in many trades, maybe trading a short for the gap close in there, but not overstaying the welcome on the short side. Like almost everything else, it requires a lower high underneath 195.50 to flip more bearish on Meta in the long term. Next up, we've got NVIDIA. What's going on with NVDA? Just a stock that cannot, should not, will not go down without a fight. It is holding up here, just, gap fill reversal, holding up in this range. Once again, the large green bodied bars are coming to an end. We're not really seeing that same strength and same just momentum that was in the stock through here. Not saying it can't break out up and over 274.25, but we'll just continue to be very cautious of new money longs up here at the highs. We'll take NVIDIA step by step. I think something like Meta is a much stronger break point, or even Apple after its phase of consolidation. Speaking of consolidation and breakout points, look at Microsoft. Beautiful bull flag. This, by every stretch of the imagination, is much more of a constructive pressure cooker top, unlike the botchery on Google that we just did. So anyways, looking for this gap to close over 282.30, closes at 285.55, and from there, there's a next overhead target at 294. Obviously, from a measured move perspective, that's easily in play. Doesn't have to happen all over the course of one day. Could take a couple of days to get there, but it's certainly within striking distance is what we're getting at. Market would not necessarily be overbought if it made that type of move. To be bearish on Microsoft, you got to break this balance in the downward direction, and you're probably targeting the neckline of the double bottom here at 260. That's underneath with acceptance 270.25. So far, so good on the bullish hold of today's gap and go. Last but not least, we've got the mini beast stuck in a range here, but it is constructive over the double bottom neckline from in here. Just like everything else that is offering a similar range, pressure cooker top at the highs, it's either an over 101.50 or an under 96.50, 101.50. Those are the two numbers. Very simply put, obviously on today's session, holding at support throughout the earlier portions of the week. Looks to be threatening an upside break rather than a downside break, but keeping an open mind in Amazon. Let's dive into these trade ideas with PLAY. That's for Dave and Buster's here. Earnings just happened, and what we'll notice is that we completely took out the prior day's low on some sell side momentum. Look at the volume down here as well. And where do we close? Right back up at the equal highs after producing from here to here a higher set of lows. And if we look left, there is some thin structure. The breakout over 36.75 should, in theory, bring us closer to the breakdown point from here at 39.30. There's not a whole lot of intraday structure to stop us through this overall move. Now, granted, the range isn't really that large conservatively. Let's just say that it's a $2 range. I think it's worth paying attention to on something that's trading sub 40. So play for maybe some of the smaller accounts. The options chain there is not the most liquid. You might just want to do it with shares if you decide to take that move. Next up is going to be GIS. This is for General Mills. And this idea is if the market does experience a pullback as a whole, this is a a great potential short setup with multiple inverted hammers suggesting lower highs and a clear flush point here at 84.65. Breaking down through that, once again, you can see the theme is to move through thin structure, potentially even down here into this breakout point that led to the upside from the earnings announcement. Taking a look on the hourly time frame chart, there's your descending triangle. There are your lower highs, sellers making some progress. All it should take is a breakdown of 84.65 in conjunction with a market that is also falling. And there's the daily breakout level we were just looking at. 81 is really the thin structure retracement. You could make the argument that there might be something at 83 to potentially offer a bounce as well. So GIS breakdown of 84.65 is primarily reserved for if the market experiences a pullback into the remainder of the week. And the last trade idea I have for you is a little bit more speculative. It's CrowdStrike. And the reason I say it's a little bit more speculative is because some other things need to take place here for it to be in play. Now, we're in an overall daily uptrend. There's no arguing that. We did just produce a new higher high, and we're down 6 days in a row. Now, we don't classically, count candles as an indicator for what will happen next, but if we can make it a little bit further into the support trend line, would it be reasonable to look for good risk reward back in the upward direction? Probably, right? So expecting a little bit of potential pullback here, 125, 127 starts to look like an interesting area in CrowdStrike to look for a reversal around the support trend line. If it reverses in full, the target, of course, would just be the equal high north of 135. What would we be looking at? 136.50 is kind of right around in here would be my target on the upside. So that's going to wrap up the video. If you made it all the way to the end, I greatly appreciate you tuning in. I know we've got night owls from multiple time zones across the world. It means the world to me that you take the time to watch the video. So with that said, hope to see you tomorrow morning at 8:30 Eastern time to catch the pre-market prep. And if you don't make it, that's cool as well. I wish everybody, regardless of tuning in or not, a green trading week.